Hey guys and girls, Greg Silverman here, CIOs and bow ties. We've got a long article for you here, so we're going to get busy quickly. No, this is the Come Learn With Me series, and this was another article which you all found interesting, and it is very interesting, if not quite detailed, but come learn with me. De-SPAC, the final phase of a special purpose acquisition company. SPACing. A successful SPAC business combination is often referred to as De-SPAC phase, or even the de-SPACing a transaction. The process generally meets the definition of a merger, but has considerations and challenges above that of most public mergers or acquisitions. In most cases, the acquirer or merged company is a private company and will be quickly moving towards becoming a publicly owned and traded company. This has its own set of unique requirements and levels of care. One challenge that heightens all the others is the compressed timeline. It's often a race against the clock to have everything necessary in place to close on time. This includes having experienced talent to lead the creation and maintenance of a newly publicly traded company. There's a lot to do in any merger going from private to public, with time constraints raises the level of difficulty even higher. Informing and retaining shareholders at this point is also critical to successfully close. De-SPAC, the final phase of a special purpose acquisition company, is part of a series of ongoing educational pieces published by Channel Check on the subject. From this edition, you should expect to gain a better understanding of top considerations related to the definitive agreement, the proxy statement, forecasts and related considerations, pipes and capital raising transactions in the de-SPAC phase, SEC and financial statement requirements. This is good stuff. If you ever want to know how to run a public company, and this is going to tell you. The agreement between the sponsors of a SPAC and the company can be merged with a definitive agreement. The agreement between the sponsor of a SPAC and the company to be merged with needs to define all the terms, responsibilities, contingencies, and covenants. This is the formal method for the owners of the target company, the sponsors, or the shareholders to understand the full deal to decide whether they want to accept it. The merger agreement must be detailed and spell out the expectations and responsibilities of everyone involved. In addition to common merger terms that may immediately come to mind, such as price, timeline, assets, tangible and intangible, the agreement should also anticipate the unexpected, like how many undisclosed liabilities would be handled, how they would be handled. Indemnification stipulations for the parties are also a must. A comprehensive section on covenants to define what the seller must do and must not do. Protects investors from potentially owning shares in the business that has been somehow reduced by the seller leading up to a closing. A material adverse change clause and an attempt to define material adverse and change could avoid later interpretations of what's included and what should be excluded. This offers SPAC shareholders an out in specific occurrences. Another question to be addressed is, should the private company be able to shop itself around? The section on solicitation would stipulate to what degree this is permitted. Conditions to be met from both sides will also be clearly defined. This includes any regulatory filings, asset changing hands, cash exchange at closing, and compliance with all other mandatory terms of this agreement, the agreement. Very detailed, very nice. Proxy process. As the SPAC seeks shareholder approval of the initial business combination, it provides shareholders with a proxy statement before the shareholder vote. In cases where the SPAC does not solicit the approval of public shareholders, because certain shareholders such as the sponsor and its affiliates hold enough votes to approve the transaction, it will provide shareholders with an information statement in advance of the completion of the business combination. The proxy or information statement will contain details about the business of the company SPAC aims to acquire, interest of the parties to the transaction, the financial statements of the company including the sponsor of the SPAC, and the terms of the initial business combination transaction, including the capital structure of the combined entity. If the transaction is going to completion and some shareholders decide they don't want to remain involved, they'll be provided the opportunity to redeem their common stock shares for the pro rata portion on deposit in the trust account. Steps for this will be outlined in the proxy or information statement. Should the SPAC not be required to provide shareholders with a proxy or information statement, the SPAC may not be required to have shareholder approval of the transaction. Shareholders then receive a tender offer statement that provides information about the target business and shareholder redemption rights. It was proxy. Additional funding. PIPEs, private investment in public equity, are not a required part of the De-SPAC process, but the financing method is often used to raise additional capital. This involves selling shares of the public company in a private arrangement with select investors or a group of investors at the lower market price. Proceeds can be used for working capital to fund daily operations, offset shareholder redemptions, invest in equipment for the company, or anything else which is defined in the PIPE agreement. PIPE transactions during the De-SPAC phase have become common and could further strengthen the newly publicly traded company if implemented properly. PIPEs traditionally come with warrants. That's why it makes investing in PIPEs such a good opportunity. Public company requirements. As mentioned above, once successful negotiations with the target have occurred, SPAC will usually need to solicit shareholder approval for a merger. They'll do this by preparing and filing a proxy statement. The matters for which shareholder approval is needed, including a description of the proposed merger and governance matters, will be detailed. This will also include a host of financial information of the target company, such as historical financial statements, management discussion and analysis, and pro forma financial statements showing the effect of the merger. If shareholders approve the SPAC merger and all regulatory matters have been cleared, the merger will close and the target company becomes a publicly traded entity. This fully subjects it to all SEC requirements. These requirements, along with tax considerations, investor relations, equity research, analyst coverage, and other public company needs, are new to the once private company. SEC filings, including a Form 8K with information equivalent to what is found in a Form 10 filing of the target company, must be filed with the SEC within 4 business days of closing. Interesting, huh? What else? Once a target company is identified and a merger is announced, the SPAC public shareholders may alternatively vote against the transaction and elect to redeem their shares. If the SPAC requires additional funds to complete a merger, the SPAC may issue debt or issue additional shares, such as private investment in public equity, PIPE deal. Skill set required for public company readiness may be very different from that available at the target company. Part of the public company readiness involves making sure there is enough information for current shareholders and those that may have interest in the newly formed public company to make investment decisions. Great article. Really enjoyed that. Learned a lot. I hope you learned something too. Greg Silverman, out.